Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about K. We're looking at the final act of Kellanova, the snacking powerhouse with Pringles and Cheez-It. It stopped trading publicly on December 11th, 2025, after being bought out in an all-cash deal by Mars, Incorporated for $83.50 a share. And what's so fascinating here, what makes it a perfect little case study, is the price action right at the very end. I mean, it was just so precise. The stock's final day, December 10th, it closes at $83.44. But the real story is the volume. It just exploded to over 42 million shares. That's nearly 15 times the daily average? A huge wave of liquidity right at the close.
Exactly, and that incredible volume, paired with almost zero price movement, really frames the whole puzzle for us today. The question isn't what happened, the data's clear. The question is why. Why did the market behave with such, robotic precision? Was it purely down to the automated market mechanics, the algorithms and the math? Or was that entire mechanism only possible because of the rock-solid strategic and regulatory certainty behind the deal itself?
Well, I'm firmly in the camp that this was all about the mechanics. The price action in those last couple of days was, for me, completely dominated by mandated institutional processes. You had index rebalancing, you had pure arbitrage math, and it basically just turned Kellanova stock into a simple cash claim. It was an involuntary, contractual transfer of ownership.
I come at it from a different way. I absolutely acknowledge the power of those mechanics in the final execution, of course. But I'm going to argue that the mechanism itself was only able to be so efficient, so razor-thin, because the strategic and regulatory certainty had already wiped out all the major tail risks. It was the valuation floor set by Mars and that key approval from the European Commission that anchored the price, letting the mechanics do their job so cleanly.
Okay, so the core of my argument is that in its final days, Kellanova wasn't trading like a company at all. It was basically a derivative of the deal contract. The stock was, for all intents and purposes, a dead stock. It was behaving just like a short-duration bond. And the proof, the absolute signature moment, is that surge to, what was the exact number? 42,765,000 shares on December 10th. That volume wasn't driven by fundamentals or market news. It was solely a mandated requirement of the S&P 500 index rebalancing. Kellanova was being kicked out, replaced by Eris Management. So you have these massive passive index funds with trillions in assets who are contractually obligated. They have to sell at the market on close, the MOC. It's a non-discretionary flow. And that kind of mandated liquidity just completely overwhelms everything. And to prove it, just look at the trading inputs that month. The stock's beta, its volatility relative to the market, it basically went to zero. It didn't react to CPI reports, Fed comments, nothing. The only things that mattered were the risk-free rate and the number of days left until closing. And the fact that the price barely moved, a range of 6 cents from 83.42 to 83.48, while all those shares were trading, that tells you it was managed through sophisticated channels like dark pools, all dictated by a pure arbitrage formula.
And that is a really well-structured case for the power of the institutional machine. I get it. But I think you're mistaking the executor for the anchor. The whole reason that 83.50 valuation was so certain with so little risk is because the really big, scary uncertainties had already been taken off the table. You have to focus on the European Commission's unconditional approval. That came out on December 8th, just a couple of days before the close. That was the last real hurdle where a regulator could have stepped in and, forced divestitures or even block the whole thing. Before that announcement, Kellanova was trading down in the low 83.10s. There was a clear risk premium priced in. The second that EC news hit, boom, the stock repriced instantly to around 83.44. That collapse in the arbitrage spread, that was the market breathing a sigh of relief. That regulatory risk was gone, and that was the necessary precursor for the mechanical efficiency you're talking about. And you can't ignore the strategy behind it all. Mars made an aggressive bid for a reason, Kellanova was a pure-play snacking asset after spinning off its cereal business. That whole concept of snackification, as they call it, it gave the company this incredible strategic value. That provided a valuation floor that was rock solid. And finally, the fact that retail investors were so confused by the whole thing, the spin-off ratio, how to calculate their cost basis, it just proves that the clarity needed for that final, tight transaction was purely institutional. It wasn't something the broader market really understood.
Let's drill down on that 42 million share volume on December 10th. Because for me, that's not just a consequence. It is the physical manifestation of the index rules taking over the entire transaction. I understand why you're pointing to the EC approval, but that was just the green light. The volume itself, the sheer force of transferring 42 million shares, that was the engine. It was a robotic, mandated liquidity event triggered by the S&P deletion. The MOC mechanism itself is designed to handle this, ensuring the most volume trades at one single defined price point. If the mechanics weren't the dominant force here, that massive wave of sell orders would have caused a price disruption, even with deal certainty. The price held firm because the mechanism was pristine and pre-calculated.
That's a compelling argument, but couldn't that volume spike also be seen as proof of convergence, not dominance? The index funds were for sellers, yes, but think about the buyers, the arbitrageurs. They were only willing to step in and absorb all that liquidity at 83.44 because the EC approval had given them absolute faith in the 83.50 payout. Without that regulatory certainty, the ARBs would have demanded a much wider spread, maybe 83.30, maybe lower, to cover that closing risk. So the price stability isn't just a testament to the mechanism. It reflects the pre-established certainty that allowed the mechanism to work so smoothly. Which brings us back to the price jump earlier in the week. That move from 83.10 to 83.44 on December 8th, that 34-cent jump was the market saying the biggest variable is now gone.
That event dictated the final profit for the arbitrage desks far more than tiny fluctuations in the risk-free rate.
See, I'm not convinced by that. Because while the EC approval took away the deal risk, yes, absolutely, it did not dictate that final tiny price movement, that last asymptotic crawl, the critical difference between the 83.44 close and the 83.50 payout. That was pure time value of money. You're talking about arbitrage desks making, 6 cents a share in profit over 48 hours. If you annualize that return, factoring in the cost of capital, it's well over 10%. That level of precision, it's dictated entirely by financing costs in the 2 days remaining. It proves that the final fraction of the price was governed by cold, hard math. The stock had to trade at exactly that discount. It's the dominance of mechanical friction over any kind of narrative.
But that precision only works if the asset is simple, and this wasn't. The corporate action history here was incredibly complex. You had the 2023 spinoff of WK Kellogg Co. Long-term shareholders had to use an IRS form 8937 to allocate their cost basis something like 94% to Kellanova and 6% to the new cereal company. It was opaque to the general public. For the final privatization to go off so cleanly, the institutional players had to have absolute 100% certainty in the outcome. Otherwise, they're not going to step in and underwrite the whole thing for a mere 6 cents of profit. The strategic value and the regulatory sign-off provided that certainty, which then allowed them to confidently handle all the friction in that final mechanical transfer.
I agree the spinoff history was complex, especially for retail. But by the time we get to the final closing price on December 10th, all that complexity is it's noise. The institutional efficiency we saw, the use of dark pools to trade huge blocks without moving the price. That system is specifically designed to filter out sentiment and historical baggage. The market didn't care about the 94% cost basis. It cared about the cash payment and the few cents of time value left on the table. The reality of Kellanova's end was that the sophisticated mandated mechanical process simply overwhelmed everything else. So to summarize my position, Kellanova's public exit is really a textbook case of market mechanics at their absolute peak. That 83.44 close, happening amidst the 42 million share trade, it just perfectly shows what happens when index mandates and time value of money math strip away everything else. The result is pure mechanics. You get massive volume with almost no volatility.
And my position remains, at this robotic efficiency was only possible was only unlocked because of the foundation of certainty provided by the strategic rationale, that scarcity value that drove Mars's bid, and the final regulatory all-clear from the EC. Those factors removed the downside risk, they locked in the valuation, and that allowed the arbitrageurs and index funds to do their dance with such microscopic precision. Certainty was the anchor.
Well, regardless of how we interpret the cause, the absorption of Kellanova into Mars definitely marks a huge consolidation in the consumer goods sector. A nearly 100-year-old public company just vanished into a private empire.
And I think our discussion really highlights that necessary interplay between foundational certainty and these incredibly rigorous market mechanisms when you're talking about a cash-out merger.
We have explored the two competing interpretations of Kellanova's final high-volume price action. Thank you very much for hearing us. Let us know in the comments what is your opinion. And if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.